My brief presentation today is essentially how to make money in a low-yield environment. So let's look at what this low-yield environment is that we're all wrestling with. It's historically low volatility everywhere, sluggish growth, low interest rates, credit spreads that are compressed, cap rates are low, PE ratios historically high, venture capital and PE funding is at all-time high, at an all-time high. Geopolitical risks abound. There's a long list of what the low-yield environment really is characterized by. The conclusion is it's really hard these days to make the 5% real return that many of us have in our portfolios, either endowment foundations or similar returns in the pension world, without doing something different, by just following conventional strategies. Most of us have approximately 80% beta exposure when you look on a look-through basis in our portfolios. The unfortunate thing is this represents a single, very large bet that has the expected return of something in the 4 to 6% nominal. If you add to that in our portfolios all of the other hedge fund and fixed income returns that are less, it really highlights the challenge of trying to make a 5% real return. So let's look at historical transitions here and see what might come next. In the 50s, 100% bond portfolios made 7 or 8 or 9%, and you could have 2 martini lunch or play golf and go home early. The 80s, we introduced a fair amount of equity into the portfolios. Traditional 60-40 portfolios still produced probably low double digits. You could get 9 to 11% pretty straightforward fashion. Got a little more challenging in the 2000s. We had much more diversified portfolios then, in an attempt to lower the volatility we'd experienced in the 90s and the early 2000s. But still, most of us who were managing portfolios in that period of time managed to eke out a 9 or 10% nominal return. Today, conventional approaches, as I've just mentioned, appear to be insufficient. On the other hand, there are almost weekly new structures or new institutional quality investment opportunities that we can be thinking about. So a more dynamic and flexible approach really appears to be necessary in order to keep pace with the return expectations on the part of our constituents. I think we owe a debt of gratitude to David Swenson, who years ago underscored the advantages of being a long-term investor, which gave us the privilege of considering private investment strategies, more flexible investment strategies, and the niche or inefficient market strategies. He also encouraged us to be bold, to be early, and to be flexible. So I think that theme of flexibility, bold, and early has really forced us to think about new approaches to the investment strategies that we're pursuing. Probably 3 or 4 years ago at the University of Minnesota, we undertook a project to look at our, what I would term, conventional portfolio asset allocation and try to see what sort of changes would be necessary in order to keep pace with expectations. The first piece of that project was, let's assess the primary risks that we're trying to address. As you can see on the top of this list, the print might be small, but not achieving the 5% real is the one that clearly stands out, and being too illiquid was the other primary concern that we had, given our experiences in the 2008 and 2009 period when we were, in fact, too illiquid. The other are more typical risks that we would hope to address, but we've kept top of mind those first 2. So looking at our conventional portfolio at that time, we were 35% public equity, 15% private. The other half of the portfolio was a mix of hedge funds, real assets, bonds, and so forth. And we characterize that as rigid buckets, relatively low complexity. Our strategy in general was to fill each of the buckets to the asset allocation target. We were, idea generation was important, but we were more reactive. I think it was helpful to have some flexibility in governance, but not critical. We were really benchmark driven, both from a return expectation point of view and frankly, from a compensation point of view. And we could pretty much make middle of the pack or slightly better returns by following that. And I think the success or failure was really marked by what the market did, high equity beta, as I mentioned earlier, keeping costs low, and effective execution was key. At that time, when we started the project, we decided that we would turn each one of these characteristics or these traits on its head. We'd look at the other side of the coin and see what a portfolio looked like that was completely the opposite, completely unconventional when it came to each of these traits. And you can see the results of that, which ends up being the asset allocation strategy that we pursued. Buckets became much more loosely constrained. Complexity increased. The focus was really on an absolute return strategy. I think flexibility and governance became to heighten reality and essential. We became benchmark agnostic or benchmark aware, not driven by the benchmarks. And success or failure was really driven by identifying themes and regimes that we could pursue more aggressively, and a increased importance on relative value assessment of each of the investments that we made, rather than just filling a bucket. So first and foremost, in our process, figure out what liquidity needs were absolutely essential. How much cash or near cash or high-grade bonds did we really, really need? And we went through that exercise deciding that approximately 4% of our annual spend was necessary, a third of our capital call budget was necessary, some dry powder for rebalancing was necessary, and that got us to an 8 to 10% allocation. The result is our fixed income and cash reduced from high teens % in our conventional portfolio to 8%. And today it's almost exclusively in cash or treasuries. Then the challenge was look at what to do with the other 92% of the portfolio. And the result of that, just to give you a snapshot of the conclusion here, we ended up with two other buckets. One we called diversifiers, which are completely uncorrelated, or as uncorrelated to market beta as we can get. And then a growth bucket, which is everything that's designed to produce higher returns. And as we mapped our assets, our existing assets at the time, into each of these two large buckets, there were some winners and losers. We reduced, frankly, our real asset exposure, particularly some of our conventional real estate exposure. We dramatically reduced our hedge fund exposure. And I'll talk a little bit more about that, because I'd like to discuss each one of these just briefly. The stability bucket I've already mentioned. It's cash and treasuries, and its primary purpose is liquidity in time of distress. And the important thing here is we made a very thorough analysis of what the essential requirements we thought would be, and then we limited that amount in the portfolio. So figure out what we needed, but don't do any more. In the diversifiers, this was a bucket that, frankly, we had less exposure in when we mapped the assets. So we've been working the last 2 or 3 years pretty aggressively on this bucket. The idea here, as I mentioned, is completely uncorrelated, or as uncorrelated as possible. We ended up segregating this 30+% into 3 subcategories. One, enhanced stability, which is really a place for income-related investments, where interest income is a significant component. idiosyncratic, which might be litigation finance or movie rights or something that is uncorrelated but just strange. And then growth diversifiers, which are countercyclical or inflation sensitive. And this includes some of the infrastructure things that we've been doing, some mine finance related activity and so forth. The growth bucket was also a challenge. We took several of the asset allocation categories that we had and we put them into one big bucket. And what it really forced us to do is make a relative value assessment of everything in that bucket, comparing one to another. And so by blending lots of different asset classes into one bucket, it really put a competition for capital at the heart of our decision making. And it really challenged myself and our team to be a lot more thorough in our analysis of a variety of factor exposures than we had previously been going through. This is a bucket that its primary drivers are places in the world, geographies where there's GDP growth, and that growth translates into some sort of investment-related appreciation, or earnings growth. In this case, it turned out to be a result in a dramatic overweighting of small cap public stocks within our IFA mandate. So just to give you an example, our IFA mandate today is probably 10% of the 9 or 10% of the portfolio, and approximately 70% of it's in actively managed small cap, and the remaining large cap exposure in our developed markets outside U.S. is index oriented. So the growth bucket really caused us to think about global themes and go where the growth is and grow where there's a tailwind of earnings growth or GDP growth. In both of those last two categories, approximately 50% of them were determined to be illiquid or more than a year, but for the most part, because our hedge fund exposure diminished greatly, it's mostly GP/LP lockup structures that would come in each of those categories. So what's the case for illiquidity? I think most people in the room would understand this chart. This happens to be private equity and buyout funds. You can see the red bars are the private returns for the 1, 3, 5, 10, and 20 years against the public market equivalents. And the enlightening thing for us here is the margin of illiquidity premium is much greater in the Asia markets and much greater in the European markets than in the US markets. And so we shifted our focus more to private in Asia and frankly reduced and almost eliminated the large buyout exposure that we have in the US as a result. Manager selection and access is always a key ingredient, and you can see from this chart on the right-hand side that global private equity and global venture have the biggest dispersion of returns. And so in our focus on the private part of the book, manager selection, as always, has gotten a very high degree of scrutiny. We spend much less time in the public markets trying to pick active management, and in fact, most of our exposure is in passively managed index funds, with the exception of the small cap outside U.S. developed manager that I mentioned earlier. So what happened to our geographic mix? The second from the left is the market cap weight that many of us would sort of start with as a metric. The red bar at the top being EM, developed, and US is the 53%. If we went to and we considered this going to GDP weighted, and until we did the math and found out that more than half the portfolio would be in strange places. So this is a TBD for us. I think it has caused us to increase our exposure in the emerging markets. We're currently at 21%, but it's unlikely that we're going to go much farther. And much of that 21%, as I mentioned earlier, is in the private market. So these would be opportunities within these buckets that were sort of new to us, and I think one of the takeaway messages in this discussion is this really gave us the freedom or the liberty to think about things that didn't previously have a home in our more conventional asset allocation framework. So we didn't have a place for litigation finance. It's currently one of our favorite themes. We had never done cat bonds or surplus notes. We had never done mine finance before, and we have now a mine finance allocation. And, you know, wine futures, music, film royalties, I'm not sure we'll get to those, but there's at least a place for those if we would make that decision. In the growth bucket, I put micro VC at the top of the list just because Alex asked us all to come here, you know. But there's other things besides micro VC that we didn't really have a place for in our old regime. So this is, again, the framework. We modeled the stability bucket at just over 2% nominal, the diversifiers bucket at 7.1%, and the growth bucket at 8.6%. And when we compared that to our conventional portfolio, this gave us an extra 70 to 100 basis point return over the long term with lower volatility. So it's a strategy that we've been pursuing since the Board of Regents and the investment committees and so forth have gotten on board the last couple of years. I think the final comments I'd have about framework assessment, I think the keys to success for us are, it has caused us to be much more relative value oriented, much more diligent in terms of our understanding of factor exposures, because now we essentially have two big buckets. So the risk, it has caused us to put in a risk system that's much more robust than the one that we had 3 or 4 years ago. I think, you know, benchmarking has been a little bit of a challenge. The commitment pacing has been a bit of a challenge. But all of these things come with the magnitude of change, I think, that we've put ourselves through. So I think, just to summarize, the new paradigm, minimize the cash drag or minimize the cash position to something that you know is a defensible position, but no more than that. Prioritize strategies that have broad market tailwinds, you know, demographic shifts, geographies generating GDP. Current trend is the historically low commodity prices, we think provides an opportunity. Assign a premium to uncorrelated strategies, so that piece of the portfolio went from, frankly, you know, 10 or 15% to now an allocation in that diversifiers bucket that is 32 or 33%. Seek alpha in smaller or niche sector-focused strategies, smaller funds, emerging market, emerging managers and so forth, which previously really didn't have a convenient home in our portfolio. And of course, overweight venture capital, which is always my answer to what are we going to do next.